Let me ask you a question. Have you tried a moving average crossover system and have you found that actually it doesn't work and it's not really very profitable? Well, if you had, you're probably like 99% of other traders out there. And in this video right here, I'm going to show you why that is. So why moving average crossover systems don't actually work, but more importantly, how you can actually utilize them to create a profitable trading strategy. Because it's not all doom and gloom. They are there for a purpose and you can utilize them to help you identify profitable trades. You just need to understand the right way to do it. So in this video right here, I'm going to show you exactly that. But before we get into it, please make sure that you are subscribed to the channel. So hit that little subscribe button below and hit the bell so that you stay up to date with all of the notifications of the videos as and when I upload them. Okay, so moving average crossover systems, and actually for that fact, any indicator-based system. We have technical indicators out there, so obviously they work in one way or another. But what we tend to find is that a lot of traders, they don't use the technical indicators in the way that they're supposed to be used, right? So they will put the indicators on the charts, they will play with the settings, and they will find a way of utilizing the indicators to kind of filter out all of the bad trades and things like that. And they're taking the wrong approach to utilizing indicators in their trading. So in this video here, I'm going to show you how you can use moving average crossovers to make money. And in the coming videos, I'm also going to upload some things about how you can utilize other indicators in your trading so that actually you'll be able to make use of them as opposed to kind of put all of your eggs into one basket and really depend on them and find that you just end up losing money anyway. Okay, because believe it or not, there is a right way and a wrong way to utilize these indicators, and they can make you successful if you use them in the right way. So let's jump over to the chart so that I can really show you where we're going wrong with the moving average crossover system. So we've got the pound dollar chart in front of us, and as you'll notice, I've actually got two time frames up here. So I've got a daily time frame and I've got a 4-hour time frame. Now you're absolutely welcome to trade just one time frame if you like. So if you prefer to just sort of focus on, you know, an hourly or a 4-hourly or whatever it is, that's absolutely fine. You kind of do what makes most sense to you. But I like to have at least two time frames up because I kind of take my long-term view from the longer term time frame, and then you can have your shorter term view and your entries from the shorter term time frame. Okay, and that kind of keeps you out of trouble a little bit when the shorter term time frame is going against the longer term view, because that just kind of keeps you out of trades that don't really have that much potential to make money in the first place. All right, but let's talk about the moving average crossover system. So why do they not work? Well, let's start by taking a look at the moving average crossovers themselves. All right, I've just picked some random moving averages here. So I picked a 21 and a 60. It's got absolutely no sort of, you know, scientific reason for that. You know, it's not the perfect combination or anything like that. I just picked two random numbers that I thought, you know, would make sense, because the way that a moving average crossover system works, or the basic premise behind it, is that you have a fast moving average and a slower moving average. And when the fast moving average crosses the slower moving average, then you take the trade, right? So for example, if we look at this here, the red line is a 21. When the 21 crosses the 60, you take the trade, all right? So it crosses over here on the 12th of March, you would then sell the market because it's crossing to the downside. Then when it crosses back up above over here on the 27th of March, you would then come out of the trade. Now, to those of you that are new to trading, you will look at that and you will think, well, that's a profitable trade, right? You know, obviously I got in over here at around 127.78, and then when it crosses eventually, that's what, 123 or 124, going towards that sort of number. So you would have made 300-400 pips on that trade. Yes, you would have made it on that trade, but the markets don't move like that. This is kind of like, this is a very big move. This obviously driven by the fundamentals here, and you're not going to get that every day. What you get more often than not with a moving average crossover system is quite a fair bit of choppy price action. So for example, this trade here, the market crosses to the upside. You get in at around 1.3015, and then when it crosses back again, which is when you get out, it's 1.2998. You lost money there. And then you take it to the downside. So now you're short once moving average has crossed completely down here at around 12916. And what you would do is you get back out when the moving average crosses again. So it kind of touches here. So potentially you could be out there. That would be a little bit of a loss. But let's say we don't get out there and we move along and we give the market some time. Well, the market then eventually crosses again at around 129.90. So where were we in? We were in at around 129.21, and then we get out 129.90. So again, we've lost money. We've been in the market for all of that time and we've actually lost money, which doesn't make sense. And this is a problem with the moving average crossover system, or any system where you're relying purely on the indicators to get you into and out of a trade, because you have to understand that technical indicators are lagging. They're all based on the price. Okay, so they're all built based on the price and obviously a combination of time as well. But what that means is that you're always at least one bar behind, but more often than not, a few bars behind, because what these technical indicators tend to do is sort of like average things out. They try to make things smoother for you, to make it easier for you to see. But obviously what happens as a result of that is that you end up getting into these trades where, you know, if you take a look at this trade right here, you're in there at, let's call it 129.86-ish. Okay, then we move along. So 129.86 over here, we move along, it crosses back up above at 131.04. So what I'm demonstrating here is that whilst if you get into a trending move, okay, so for example, here the market is trending upwards and we get in there at 129.13, the market moves up and then we eventually, it crosses back down at around 131. So you would have made maybe 200 pips there. Fantastic. Right, so the moving average crossover, it works in some circumstances where you have a big trend in place, but more often than not, when you don't get the big trends, when you just kind of, you do get trends, but they're kind of ebbing and flowing as the market does. It's just normal market behavior. What ends up happening is that you either lose money or you make very, very little profits on your trades. Because if we take a look, all right, let's go back to the chart. So let's take a look. This move right here, let's say that we got in there at 129.10, roughly where the moving average crossed. And then we get out over here where the moving average crosses again at around 130. So that's what, 60, 70-ish pips that you would have got on that trade. But where does that trade actually go? So if we look at where the moving average crossed, 129.10-ish, and it actually goes up to a high of 135. So there's a 600 pip move there in terms of price, but because you're just following the moving average, which is lagging behind the price, actually you're only getting 60 pips out of a 600 pip move. So you're getting, 10% of that move because you're following the moving average crossover. All right, which obviously is what I'm trying to show you in this video right here, is why you don't want to do that, because it is kind of like, it's a recipe for disaster. It's a recipe to make sure that you're not going to, when you get the moves that you want to get, you're not going to make as much money as you want. But when you get the moves that you don't want, so i.e. the ranging price action where it's going sideways, you're going to end up losing money. All right, so that there, I hope I've kind of proved to you why these systems don't tend to work when you use them the way that most retail traders use them. So with that being said, there must be a way to use them, right? Because obviously if there's a wrong way to use them, somebody somewhere has created these things and they found them useful. I know professional traders that use indicators in their trading all of the time, but there's a right way to do it. So how do we do that? Well, let's take a look. So going back to the way that I like to trade, so using 2 time frames, okay? If we look at this here, we say that we're going to take our view off of the longer term time frame, okay? So that's to say that if the moving average crosses to the downside on the longer term time frame, I'm going to look for my entries on the shorter term time frame to the downside. So let's take a look here. So 13th of May, somewhere around there. That's around here on the charts. What I could do instead is I could say, okay, well, when the market turns to the downside, so it goes short, I can then wait for the shorter term chart to also turn short, okay, which it does over here. So now it's starting to sell off. And then as opposed to trading the moving average crossover, I then look for price action entries. Okay, so for example, I would have a break of a support candle over here. So I could get in there on the 15th of May with a relatively short stop and get out relatively quickly as well. So within, 4 to 8 hours there, I would have got my profit target. And then I can take stock and look for another break of support, which we get here. So then I would be in here again. In fact, let me just get in some drawing tools so you can see exactly what I'm talking about. So the initial one was around there. You could have another entry in here. I could have another entry in here. This one, not so much. You'd have another entry in here. This one stops you out, but you are going to be stopped out. It's not, a game of certainties here. We've made 1, 2, 3 good trades, 1 bad trade. Maybe we have a trend line in there. That's another good trade. So that would have been 1-to-1. You would have made your money, all the while. So we've taken our view from the longer term chart. So this here, where the moving average crosses around this point over here, then we go to our short-term chart and we look for the short entries. We're not getting in because of a moving average cross and getting out because of a moving average cross. We're simply using the moving average cross to identify the market conditions. So to tell us whether or not the market is in fact trending. So is the market moving in a particular direction or is it moving sideways? Okay, and if it's moving in a particular direction, then we can jump down to the shorter term chart to look for confirmation and to look for our entries. We don't just trade it because the moving average crosses, because if we do that, as I said before, if you base anything on indicators, whether it be the moving average, the stochastics, the CCI, however leading people will try and make you believe an indicator is, it's all based on price action, which is obviously it's going to be old data by the time you get to the charts, by the time it's manifested itself. Okay, so that's a moving average crossover system. The do's and don'ts of a moving average crossover. Don't just trade the cross blindly. Try not to, if you can, trade just one time frame. Take your view from the longer term time frame and then take your entries from the shorter term time frame. Use the moving average cross to indicate what the market condition is. And once you understand what the market condition is and both time frames align, so if the longer term time frame is telling you to go short and the shorter term time frame is telling you to go short, then you look for entries from a price action perspective as opposed to taking it from the moving average cross. And if you try that, I promise you your results will improve. So, in fact, do that. Go away, test it, do some live trading and post beneath the video. Let me know what your results are and if they improve based on, some of the concepts I've given you here, because I'm really fairly certain that they absolutely will. And if you're interested in trading with me, then there's a link beneath this video here. Every Wednesday or most Wednesdays, I'll do a live trading session where people can jump on the line with me. They can ask any questions they want about trades that they may be in or strategies and things like that. And I will do my best to answer them. And I do that all live, as I said, every or more or less every Wednesday. Until I stop doing it on a Wednesday. But at the moment, I'm doing it. If there's a link beneath this video, there are live trading sessions on a Wednesday. So click the link below, put your details in, and I will see you on the next live trading session. And if you have not subscribed, if you didn't do it at the beginning, do it now. Subscribe to the channel, and I'll catch you in the next video. Take care now.